we're looking at how transactions affect accounts. So we talked about the T-charts last lesson, and today we're going to actually go into different transactions and see what T-charts they would affect and how it affects the accounts. So each transaction is going to change the balance of at least two accounts. There is always multiple accounts for each transaction. The list of accounts used by a business is called a chart of accounts. And so here's an example of a chart of accounts. The 100s are always your assets. The 200s are your liabilities. Things you owe, and remember, accounts receivable is when people owe you. 300 is the owner's equity, and these are the only accounts that will ever show up in owner's equity: your capital account, your drawing account, and your income summary. Revenue is the 400s, that's the things that come in, and you may have your revenue split up into multiple accounts, but a lot of times there's just one revenue. And then your expenses. Your expenses are some of your biggest list of items. Usually you have more expenses and assets to list than anything else. And so anything that comes in as a separate thing, like your advertising expense, your communications, your equipment rental, insurance. Then some things that will not happen very frequently, they may be grouped under a group together, like the miscellaneous expense. We'll talk about, I think it's in chapter 6, that we go over cash shortened over. And then your supplies expense is down here. This list is not exhaustive. That means there's more things that can be added into it, and it will change by the business of what the business owner feels like they need. So if we receive cash from owner as investment, so that means that our cash is going to be changed, and then our capital is going to be changed because we received cash. And so when we talked about this last lesson, we talked about cash is going to increase on the debit side. Capital is going to increase on the credit side. And so we have to have a debit and a credit for every transaction. Since cash is the asset, it gets increased on the debit side, and since capital is the owner's equity, it gets increased on the credit side. So we paid cash for supplies. So that means that we paid cash. That means our cash is needing to go down. So to go down, we would need to have it as a credit on cash. What would go up is the supplies. The supplies account will go up. And so since it's an asset, the supply increase is going to be a debit. So we paid cash for insurance. And so our two accounts are our prepaid insurance and cash. Cash is going to go down because we're reducing money from our account. And so credit is a decrease. And then prepaid insurance is going to increase because we're putting money in it. And that's a debit that increases. I typically, when I'm trying to do a transaction that has a cash in it, that helps me to choose because I can easily see what's happening to cash. Is money coming into cash or is money leaving cash? And that's the easiest transaction to first start with and know that the other one has to be opposite. Bought supplies on account. So this time, if we're buying supplies on account, that means that we are going to be dealing with an accounts payable and then also our supplies. So our accounts payable is a liability. Liabilities increase on the credit side. And we need to have our debit that matches. Supplies is also increasing, and it's increasing on the debit side. So our accounts payable increases on the credit side because it's a liability, and our supplies increases on the debit side because it's an asset. So we pay cash on account. So that means our cash needs to go down. If our cash goes down, that's a credit. We are also going to lower our accounts payable. That's going to be a debit. Liabilities decrease, that means it's on the debit side, and assets decrease, which is on the credit side. The cash is accredited, and accounts payable is debited. So when analyzing the transaction, which accounts are affected? How is each account classified? How has the classification changed? Is the amount entered? How is the amount entered? Is it a debit or a credit? On the classification changed, is it an asset? That means it's increasing on the debit side and decreasing on the credit side. Which two accounts are affected when someone buys supplies on accounts? Supplies and accounts payable. So let's look at our work together. So here's our account titles. Here are our transactions. I'm going to unpin this again so I can have it move with me as I go down the page. Just makes life a little bit easier. And I'm just going to pull it over here. So on March 1st, we need to figure out what happens. We received cash from owner as an investment. So that means our cash and our capital accounts are both changed. Cash increases on the debit side, and it said we received $4,000, and capital increases on the credit side. So let's bought supplies for $95. So that means, and like I said, I always look for the cash. Where's the cash flowing? Cash is leaving, so that means it's a credit. And it said we lost cash of $95, and it went to supplies. So supplies is the account we receive it, and it is $95. So let's look at March 4th. We bought supplies on account from Supply Depot. So there is no cash here. We're buying it on account. This means we're going to have an accounts payable, and our supplies accounts are both changed. Supplies is an asset, so if we're increasing assets, that would be on the debit side. So supplies first, and it was $120. And then $120 goes to the accounts payable. Paid cash for insurance. So if we paid cash, that means our cash decreased. That would make it a credit. We paid cash to insurance, $250. Well, our insurance right now that we're working with is the prepaid insurance. That's an asset. It's going to increase on the debit side by $250. Well, on March 9th, we paid off some of our debt. So our cash is going to decrease because we paid cash, so cash goes down. And if cash goes down, it's going to be as a credit. That also gives me a clue, because we're going to the other one as your accounts payable. And so if cash was decreasing and was on a credit, when we decrease accounts payable, it's going to be a debit because we're paying it off or taking down our tab. Save and continue. I want you to work on your own 2.2 and then do the application.